As we leave 2017, many will look back at missed opportunities as the risks that we were warned about never seemed to materialise. Despite tightening liquidity in the US, equity indices were going from strength to strength and continue to do so well into the last month of the year. Emerging market continues apace and the bond bubble's not burst. Oh, and cryptomania caught hold. Charles Dumas joins us now from TS Lombard with a view into 2018 and beyond. Charles, welcome. First of all, what is the attitude we should be taking with us into 2018?
Well, I think the most important thing is that for the last couple of years we've had pretty steady expansion against a backdrop of widespread pessimism. And the important thing to understand, I think, is that the post-crisis blues have largely ebbed away. And at the same time, for the first time this century, we have reasonably well-founded global expansion based on three perfectly good locomotives driving domestic demand, those being the United States, China, and North Central Europe, gathered around Germany. And the difference between this and the pre-crisis period, 12 years ago, is that now they are not depending upon a heavy run-up of debt in order to create the growth.
How has that come about?
Well, it's come about because the Eurozone is recovering. China has got self-generating domestic demand growth, and the United States always has. So the key factor, the new factor, if you like, is the Eurozone being relatively buoyant, in particular the countries around Germany and Germany itself, which if you take Scandinavia, Holland, Belgium, Switzerland and Austria, collectively they have an equal GDP to Germany, so it's Germany times 2.
Yeah. What about immigration? How has that changed things? Because we hear a lot about the way in which the dynamic has changed, especially across Europe as well.
Yeah, well, immigration is a key factor. If you go back 5 years, you find that it was expected that the German labour force would shrink by 0.5% a year. That was all part of the supposed indigenous shrinkage of the German population. And that was expected to persist for 20 years. Well, now, in the first 7 years of the period covered, starting 2010, the German labour force has not shrunk at all. On the contrary, it has expanded by 1% a year. So that's something which is completely unexpected, really, in terms of people's investment behaviour. The thing is that demographics are supposed to be stable and predictable, and in fact they've proved to be very unstable because of migration, and also, of course, because of the refugee influx. And the result is that, that Germany has a shortage of capital. It's expanded its labour force against expectations, and it lacks housing, working facilities, various forms of infrastructure, roads, schools, etc. But also it lacks investment in machinery and equipment to grow the economy and to match the growth of the labour force.
I think you've got a good chart we can bring up to explain a little bit more about this. Explain what's going on here, because clearly there's been some increases, big increases.
Yeah, well, the point here is that the black bars on the left represent the forecast of 5 years ago, made in 2012, for the 20 years change of the labour force since 2010, from 2010 to 2030. And the blue lines to the right show you what's actually happened in the first 7 years of that period. And you can see that there's a radically faster advance than was expected, or in some cases an advance instead of a reduction, as in Germany. So that's the main point here. And it creates a shortage of capacities. Now, the other thing to remember is that the savings rate in Germany has been held quite high in the last few years, because the people retiring, which is normally the generation that passes from high saving to low saving in retirement, those people were a very small generation born in the 1940s after the Second World War, and with lots of people of childbearing age having been killed and all the rest having no money. But now, the people retiring and moving from very high saving in late career to no saving or low saving or even capital consumption in retirement, those people are in fact nowadays increasingly the baby boomers, because the retirement age is 66. People reaching 66 this year were born in 1951, and the size of the generations increases year by year for the next dozen years or so.
So how's this twisting inflation? Because we've seen inflation has not picked up in the Eurozone. I think this is one of the big bugbears for Mario Draghi and the ECB team, is that it hasn't picked up. They're pumping all this money into the economy. We know that tapering is going to start into 2018. What about the inflation picture going into next year?
Well, I mean, I think the inflation is fine because where traditional forecasting really got it wrong in the Eurozone's case was in supposing that inflation would come first to Germany because that's where the demand is strongest. But in fact it hasn't, because what's actually happened is that they've imported a whole lot of people and therefore that has held down wages in the most obvious kind of way, but in a more general sense, if you increase supply, it takes care of inflationary pressures on the demand side. So, so the whole thing has stayed reasonably in balance in terms of supply and demand. And that's all very positive, of course. Now, it does not alter the fact that it is not appropriate for a country with above-trend growth that's been growing at an above-trend rate for 4.5 years now to be sitting there with a nominal interest rate that's negative, a real interest rate that's massively negative, and a whole heap of quantitative easing on top. So the monetary policy is quite clearly its chief real objective is the protection of Italy from a rise in the euro. But its nominal objective is to hold down the rate of inflation. Of course, the rise in the euro that we've actually had is holding down the rate of inflation and therefore enables them to continue with an easy monetarist stance for much longer than they should. The result, of course, is liable to be that the whole thing picks up and overheats, but that's 2019's story.
Well, I was going to say, we'll move on to that in just a minute. I want to bring up a chart, another chart that you've got, which talks about core inflation restraint. I think this just goes to show what you've just been talking about, doesn't it? Explain a bit more about what's happening.
Yeah, well, this is US inflation at the CPI level, and obviously the interesting one is the white line in that chart, which shows you the core inflation without food and energy, that is, but also without rents. And it's roughly speaking 0.5%. So for practical purposes it's zero, because most people think that US inflation is a bit overstated anyway, because the high-tech measurement of high-tech goods inflation has been, of course the prices have been falling, but the prices have actually been falling faster than the measures suggest. So really, for practical purposes, US inflation is zero, its natural rate of inflation. And the only reason why the rate is as high as it is, about 1.5, 1.75% in the core measure, is that rents are advancing fast. Well, that's a function of the fact that after the housing market crash, nothing got built for several years, and now there's quite a large generation of people in their sort of 25 to 34 age group who are sort of needing housing, and so rents are going up quite fast. But that's not really a function of the broader market economy, where inflation is effectively close to zero.
Markets pricing in something like three central bank rate rises next year from the Fed. Is that in line with your expectations?
Yeah, we've been saying that as of until about a week ago, we were saying there are going to be 4 more hikes in the next 12 months, and we've had one of them, so 3 more to come. But we're not sort of concerned here about the Fed closing down the economy, because it's the other way round, actually. It's the strength of the economy that makes it necessary to have these increases. And really what one's looking at here is that the Fed's view of the correct rate of inflation, the neutral rate of rate of interest for federal funds rate, is 0.75% above the inflation rate. The long-term historical average, by the way, is 2 percentage points above, so the Fed's already accommodating rates being lower these days than they were in the past. But the actual rate, of course, is bang on the rate of inflation, the Fed funds rate, and therefore effectively is an easy policy, even in America, leaving aside what I've already said about Europe. So you've got easy policies essentially across the whole spectrum of the Atlantic community.
Is there anything that worries you about 2017 before you 2018, I beg your pardon?
Well, yes. I mean, I would say that if you run excessively easy policies in economies which are above trend and are growing at an above trend rate, then you're liable to, you're almost certain to create overheating. You may achieve your 2% inflation target, but only through overheating, and you don't get rid of overheating by sort of waving a magic wand. You get rid of overheating by recession. And so the concern has to be that two things really. One is that we are going to get into significant overheating by the end of the year, and therefore there will have to be a clampdown in 2019.
Are we talking Eurozone, US, globally?
Talking US and Eurozone, right. But particularly the US. Possible clampdown in 2019, and if that were to happen, then the central banks would own the downswing, because this overheating is unquestionably a function of their choice of policies and their use of this 2% inflation target, which to my mind has no justification whatever.
So central banks are following the wrong policy?
Yeah, they are following the wrong policy, of course. I mean, why do we actually want to create inflation in economies which don't have natural inflation? I mean,
it shrinks debts, of course inflation does.
Well, the purpose, if you want to shrink debts, you can always repay them, you know. It doesn't actually have to be achieved by distorting the pattern of prices in the economy. And so what we've got is a situation where the central banks are pursuing a policy which has every risk of creating a melt-up in the stock markets. And if there is a melt-up in the stock markets, and we regard that as the chief variant from our sort of reasonable advance forecast, that melt-up will almost certainly provoke some sort of central bank reaction, which will be a classic case of too much, too late. Mm-hmm. Or putting it another way, what used to be called stop-go policies, and what we now, I suppose, would have to call go-stop policies.
Right, okay. That's likely to occur, you think, at the back end of 2018, early 19, or is it well into 2019?
If it happens, that's the sort of timing, yes. You get a bubble late in 2018 or in 2019, yeah.
Okay, and interest rates from where we are at the moment, well, by then, will the European Central Bank have stopped finished their tapering and started to QT?
Yeah, we think they'll stop their tapering at the end of September, but I mean, that's already 9 months in, and monetary policies operate with what are pleasantly known as long and variable lags. Yeah. In other words, the liquidity that was created this year is already is going to be pulsing through the economies next year.
Mm. Okay, all right, interesting situation. Thanks very much indeed for joining us with a look ahead to 2018 and beyond. That is Charles Dumas from TS Lombard.